Good afternoon, everyone. This is John O'Hare from O'Hare Wealth Management, and this is our weekly update. And you just have me today. My son and Jerry are doing other important things. As many of you probably already know, we record these a day ahead of time now. We used to try and do them live. We found that doing it a day ahead of time gives us more time to get content approved, and we believe it's making for better calls. But since this is Wednesday and you're looking at this on Thursday, you're going to be hearing a lot about GDP being announced. And that's related to the first question we have this week. Actually, it's the only question we put in this week is, are we going to have a recession? And if you look at the number, the GDP number, it was negative. And most of you probably know or will read that when we have a negative number, if we have 2 quarters of negative numbers, that means we're in a recession. That's the traditional rule of thumb. So this is a good time to have this call and talk about GDP because the number yesterday was incredibly messy. It is not indicative of what's really going on in the economy. Why? Because we had massive imports to get ahead of the tariffs that have been proposed. So in a normal quarter, say we have 2% growth or 3% growth, import exports, it's net of that because we import more than we export. We'll usually subtract 2.5%, maybe as high as 3%, as low as 2% off of GDP. This quarter, it subtracted 5%, twice as much as normal. So if we had applied a normal export number, we'd probably be around 2% or a little higher for GDP. And it all makes sense. If tariffs are coming, companies are trying to get products and materials in ahead of time. But it did massively distort the number. So we're not worried about a recession. In fact, we adjust for 2% growth is about what we expected. Last year, we were as high as 3% growth, but the long-term trend line for the U.S. is about 2%. So this is normal. And we expect it to slow a little bit from here. The positive news was inflation was softer than expected, and that will help the Federal Reserve as they look at lowering rates over the next 9 months. Listening to CNBC this morning, the reports are still there could be 2 or 3 rate cuts this year, which are positive for the economy and will be positive for stocks. So are we going to have a recession? No, we don't think so. And we certainly, more importantly, are not in a recession right now. But the concern has been with all the noise around the tariffs, could this cause a recession later this year or next year? So let's look at the first slide. I've got 3 slides for you today. And I want to point this out because it'll help you get your arms around what's going on. These are the 10 biggest exporting industries in the U.S. This is the U.S. exporting to other countries. The largest thing we export now is oil and gas. And that's amazing because up until about 4 or 5 years ago, we were always a net importer of energy. We are now a net exporter, and that is a huge fundamental change. In my career, we've been a net importer since the 70s and 80s. So this is a big positive. By the way, the tariffs announced by the current administration had excluded energy products. So they're not putting tariffs on stuff we import. So I don't think the other countries are going to put tariffs on there. But looking at these top names, number 1 is oil. Look at number 3 is petroleum. Number 5 is natural gas. 7 is organic chemical manufacturing, which comes from petroleum. 8 is plastic and resins, which comes from petroleum. Most of our exports are things that shouldn't be caught up in the tariff war. And more importantly, these are things that other countries need. So we're probably not going to see as much damage to our exports. Now, by the way, exports in the U.S. Are 7% of our economy. It's actually 11% if you include services, but services have not been a part of this tariff war. But for materials and goods, it's 7%. So we're unlikely to see a big decline in our exports. We might see a little decline, but this isn't massive. If everything we export is 7% of our GDP and we stopped all of it, that would be causing a recession because that would be a knock of 7% of GDP. But it's unlikely we're going to see a huge change for this. There'll be a little bit of change in there. But some of these things, like number 4 there, brand name pharmaceuticals, those are things, if you want to make your people healthy, you're going to have to buy those. So that's some of the good news. Let's look at the next slide. Who are our biggest trading partners? Where are we importing most of our goods from? And again, we import more than we export. So there's a deficit every year. The big players, and this is what you've heard if you've been listening to the news and the administration, are Mexico, China, and Canada. Surprising to a lot of people, Mexico is actually bigger than China, and they're an important trading partner. But again, we have a $31 trillion economy. That's 31 trillion. You have China, Canada, and Mexico accounting for 1 trillion of imports. So it is about 2% of our economy. It is important. They're not all going to stop. Some of those will be reduced. Some of them will be more expensive, and the stuff we import in for car parts or steel or aluminum will cause prices for goods to slightly rise. Now, for these countries, exporting to us is a very important part of their economy and keeping it going. So everybody's going to be working to try to make this good for all sides. But to give you an example, some of the stuff we import will go into housing or cars. And housing is a good example. We build 1.4 million houses in the US every year. We have 130 million households. So every year, 1% of households buy a new house. Now, that new house is probably going to cost $10,000 or $20,000 more than it did before, but it affects a small part of the population. We sell about 15 million new vehicles per year in the U.S. So about 1 in 10 households buy a new vehicle each year, and it'll cost a little bit more. But this isn't devastating where people will stop buying houses and stop buying cars and the economy will come to a screeching halt. But it will have a slowing impact. On the positive side, we're going to look at the last slide, which is on inflation. And try and point out a couple of key things here. If you look at this chart, inflation peaked in the summer of 22 at 9%. It's all the way down to 2.4%, which is actually lower than it was in 2018. Notice the big drivers of that inflation were energy, and that was because of the Russian invasion and war with Ukraine that drove energy prices to $120 a barrel. They're back to $70 a barrel now. You also had high cost of food at home because a lot of goods were in short supply. But importantly, look at the core goods. That's that orange line. When we reopened from COVID, there was a supply chain issue. We couldn't get enough goods manufactured and back in the country. So inflation was being driven hard by core goods. If you fast forward a few years here, like 2024, core goods were actually a positive. They were negative coming in here. And the concern is that core goods will actually bump up inflation again. And it's possible. We've seen some different estimates, like Goldman has said it could add as much as 1% to the inflation rate. And yes, that is possible. But overall, that is not going to slow our economy. If we're 2.5% inflation, we go to 3.5%. That isn't going to draw us all to a stop. Importantly, goods have been helping us right now. The big one actually is shelter. Again, looking at the chart, if you look at the bottom, the dark blue line, that's shelter. Shelter is about 40% of inflation. Well, tariffs aren't going to have a big impact on that. That is owner's equivalent rent and apartment rentals. And everything we see in the market right now with higher mortgage rates, we had a record low sales of existing homes last year. So prices there are most likely trending down. So if shelter is 40% of the index and home prices are trending down and apartment leases are trending down, most likely this will be positive for us and continue to be a lower number. But to wrap this up, we really don't see the tariffs causing an extreme change in our economy. Will it slow some things? Yes. Will it slow specific industries? Yes. Some industries won't be touched much at all by this. Do we see a slower economy this year? Yeah. If we had adjusted, if we had 2% growth last quarter, we could be down to 1.5% by the end of this year. Again, if that happens and inflation continues to trend down lower X the costs of tariffs, the Federal Reserve should be able to lower rates, and that'll be a positive for our economy and a positive for the markets. But I hope this helps. Again, send us your questions. If you have follow-up questions on this, send them to us. We'll try and address it next week. Although next week, myself and my son and Jerry, and actually Josh, will be at the Stewart Partners Symposium in Orlando, Florida, catching up on our business trends and our company. So we'll be back the week after to address your questions. With that, we're going to talk about the new book. And this book, I just finished it recently. My son, John, is going to do a quick video on this and give you more detail, but it is called The 5 Types of Wealth. And it came out recently, and I enjoyed it very much because we tend to think of wealth as only money. And there's other types of wealth. And some of the wealth they talk about here is health, it's family and friends, it's time. Young people have a wealth of time versus someone who's in their 80s. They don't have a lot of time left. And I thought it was well worth the read. I would recommend it to most people. And I think it was an easy read too. You'll enjoy it. With that, we're going to wrap up for today. Thank you very much, and we will see you soon.